Swadika, ladies and gentlemen, welcome back to another session of today. Our next panel will be a story of tailwinds and headwinds, liquidity in APAC, Equiti experts and liquidity providers. Please give a warm welcome to our moderator, Mohammad Isbeer, Global Head of Brokerage Sales at Equiti Capital, who will introduce the panel. Please give him a warm welcome. Thank you.
Thank you very much. And thank you very much for your attendance as well. As you said, my name is Mohammad Isbeer. I am the Global Head of Brokerage Sales at Equiti Group. I'm very delighted to be moderating this panel with these amazing panelists. And I would like to give everyone maybe 30 seconds to introduce yourselves to the crowd.
Yes, hello. My name is Despina Savvidou. I'm the Chief Risk Officer at Match Prime Liquidity. We offer liquidity to several CFD brokers on different asset classes, and we can customize on the needs of our clients. So we are here to answer any questions you have. You can come by our booth, and we're happy to help.
Hello, everyone. My name is Phil Kim. I represent ISAM Securities. Some of you might not know that we're part of a larger group. ISAM is International Standard Asset Management. We're a $5.5 billion systematic hedge fund. We've focused on two main points or two main parts of the business. IS Prime, which you may have heard of. It is our liquidity business. We have tier one liquidity, multi-asset, prime brokerage business, and services to institutions. And then we also have a separate component, which we tie in with our clients, IS Risk. IS Risk is a very comprehensive consultative service which is provided to brokers. It provides real-time analytics, alerts. We can customize anything that you'd like. We have a risk management solution for many of the largest brokers in the world, and we have our own proprietary technology as well.
Thank you, Phil.
Hi, everyone. My name is Anya Aratovskaya. I'm VP of Institutional FX for the Advanced Markets Group. Advanced Markets is a prime broker. We are primed by UBS and Standard Chartered, and we are focused on providing spot FX and metals liquidity. We are one of a few providers on this expo that can show you the bank where you were executed. Thank you.
Hi, Alex Mackinnon from Finalto Group. I head up our Asian business based in Singapore. Finalto, if you don't know who we are, is a multi-asset broker. We provide a lot of liquidity to the institutional market, some of the participants here in the conference. And we're here to talk about the expansion to Asia, which is very close to our hearts at Finalto.
Yeah, thank you, everybody. My name is Wael Hamad. I'm a Chief Commercial Officer of XS.com. I'm pretty happy to represent our company as a multi-assets broker with also strong presence, global presence. And we are also happy to be part of this incredible panel, where is the high level of experts. Maybe we can exchange and gain from their experience in this industry. And we also looking forward to answer and discuss all the challenges and potential that exists in this region.
Yeah. Thank you, everybody. So as you can see, we have a panel of different backgrounds, different experiences, and so what I'm going to try and do, and I'm going to try to direct questions to each of you individually, giving your backgrounds and your respected companies, but anyone who feels like they need to, they can jump in and maybe help. That would be perfect. So our main story is liquidity. The title is Story of Tailwinds and Headwinds, of Asia liquidity. So I want to start by the essence of the liquidity and prime brokerage. And I want to direct this to you, Alex. So you've been in this space for a long time. You have worked in Europe, which was pretty much a very mature market in that sense. The barriers of entry is easier to PB word, or at least it used to be. How do you see the landscape here in Asia in terms of accessing the prime brokerage, barriers to entry, competition?
I mean, the barriers of entry in Asia is very different to Europe. And if we get into the regulatory side of things, there's 20 plus countries with 20 different regulations. So it's very different to Europe. So I suppose that's the hardest thing. And the restrictions in leverage, etc., in certain countries, which is in Europe now. But I mean, that's the regulatory landscape, and spreading capital across multiple jurisdictions is the hard bit. But entering Asia into providing liquidity, I suppose if you look at our title, it's the Tailwinds. You do have one or two regulators in Asia that's really promoting bringing liquidity, discovery, and execution to the space. And we're lucky that we picked MAS, and they're probably one of the leaders now in promoting Asian liquidity, execution, and.
And in terms of the prime brokerage, I know like in Europe, there's quite a few well-known names. You've got the NatWest and the BNPs. Do you have prime brokers in Asia that are specific to Asia?
Look, I'm not plugging any particular name, but I mean the Asian-focused PBs out here are Standard Chartered, NatWest, and you could say, sorry,
HSBC.
And HSBC was the next one. But they've all got their own restrictions on who they will see and talk to. But that's the same with, say, UBS and whoever else in Europe.
Yeah. Okay. All right. So maybe move a bit from the PB space, and maybe this is to you, Despina. There's a lot of I don't know if it's rumors but everybody's saying the flow that comes from Asia is quite different to the rest of the world. There's certain types of clients, certain types of strategies that are being run out of Asia that some of the brokers and the liquidity providers have been complaining about. First of all, I want to ask you: do you think this statement is true?
Yes, of course it's true. We see that traders from Asia, they tend to trade in different types of products. Firstly, I would say they mainly trade on FX and metals. They have different strategies as opposed to the European. European can have more long-term strategies on equities and some major effects, but from the Asian region we see also some high-frequency trading, and we see the different kind of mentality and different kind of execution needs, also execution requirements. They need a faster execution, which is crucial.
Yeah. And how would you handle that from a liquidity perspective and from a risk management perspective? And I know these are quite tough conversations to have, whether on the LP side or the client side. So how do you deal with that?
Yes, basically we are able to create different liquidity pools according to the flow, according to the products, and also the regions that the end clients of our broker clients are operating. So we can customize. We can have different products for other groups, and we have a dealing team that can analyze this flow and act accordingly.
Anyone else would? Yeah.
I have actually a question.
Yeah.
So if you would have to rate from like 1 to 10 on how easy it is to manage flow from Asia, how would you rate it in comparison to, for example, European flow?
In comparison to the European, it's a bit more difficult in terms of monitoring, but if we have the right resources, we definitely can handle any type of flow. We just need to have specific risk framework in place and the specific attributes that we want to check for each of the different flow that is coming from different regions. So I wouldn't rate it specifically for Asia or for Europe, but there are different types of trading strategies in Asia throughout. Okay. So,
what about? I mean, and this is for everyone. I mean, what about from an educational perspective? Sometimes there are certain requirements that comes through that doesn't really make sense, you know, clicking clips in certain sizes and or front running the market in certain ways. I mean, what's your thoughts about, you know, educating the market and, you know, being able to be more, you know, give them more the knowledge that, you know, you have in Europe, for example, or in the US? Phil, you had something?
I've been in Hong Kong or in Asia for the better part of 12 years. There's been a big growth in the region. It came with maybe slightly less sophisticated or less educated customers at one point, and now there's a lot more understanding of the market. So I think, to your point, understanding the region, understanding the client base, what the need is very important. Like you said, in terms of managing the liquidity, that's very important, because I do believe that there's a very unique type of customer or group of customers in the region, and it needs to be handled slightly differently, or maybe entirely differently than Europe. And I was originated in New York. I worked for a couple of British companies, and now I'm in Hong Kong. So I've seen the full gamut.
Yeah, I mean, we're also kind of like quite focused on the Middle East, and we see a completely different kind of set of trade flows and client types in the Middle East. And for me, you know, it always comes down to education, because some of the demands, understanding the liquidity provisions and the underlying markets is of an essence. And this is what I believe is that, you know, something that we need to massively work on as, you know, as LPs in this region. If you have something to say, Wael?
Yeah, I think like by highlighting the all negative and positive impact of liquidity provision these days, and become like upfront to the clients, maybe it can also inform and give them a space where they can build their informed decisions, and also they can manage their expectation effectively. So this is just I want to.
Absolutely. Okay, so just to kind of move to another question, and this is more on the commercial side. And Phil, I know you manage the sales team in IS Prime in APAC, and maybe my question is more directed towards what are the type of clients that you see in Asia? Are you predominantly working, I mean, aside from the retail side, this is more about liquidity. So are you dealing with retail brokers, hedge funds, family offices? What sorts of clients, and how do you build a strategy? Because in Europe or in the US, you know, the regulation is quite clear, and you know exactly what you're getting, what types of clients are you getting, so you build your commercial strategy accordingly. In Asia, you know, aside from, you know, you got Australia, Japan, Hong Kong, maybe Singapore, that's quite regulated, but you have 20 other countries that, you know, falls under, you know, outside of the scope. So how do you build your strategy from a commercial sales perspective?
I think quite a bit of it comes from just experience. I think of all the customers you mentioned, all of the above, essentially. We have family offices, retail brokers, hedge funds. We have some regional banks as well. As far as the liquidity standpoint is concerned, you know, we have some brokers that are, you know, very sophisticated. They B-book or A-book, let's say, a lot of their business as well. So it's really difficult. You need to understand the regions and certain countries as well. Certain countries, perhaps like Japan, it's very retail brokerage oriented. Perhaps same as Australia. Australia has quite a few large brokers as well as the hedge funds. Maybe in Southeast Asia, maybe slightly smaller brokers that have large aspirations. They have a big client base, whether it's from Southeast Asia or North Asia, and they grow very quickly, and they're you know, infiltrating into some of the European businesses as well.
And would you have different types of liquidity to each of these, you know, client segments? I mean,
yeah, no, absolutely. Not only different types of liquidity, but different, I guess you can say, different pools or different subsets. Some that that you understand that this is all they need. Most of their customers are GUI clickers. Some of them are API customers, much more sophisticated. Use algorithmic systems as well. So you really do have to tailor it. And I would say that one of the things, I'll just mention that one of the things that we feel that we're quite good at is we have a risk analytics business, and it really is all systematic. So we're able to very systematically manage risk, manage the liquidity, and really optimize it for brokers of all sizes to be able to increase their revenues and mitigate their risk.
I wanted to say, I think all of us here are definitely separating the liquidity that we provide for, let's say, family offices or funds versus retail brokers, because retail brokers are dealing with a smaller size clients, so they would not need a depth of market of, I don't know, like 10 lots, or like 10, but like 10 million, let's say, because in most cases they will not be executing large order sizes. But we're talking about funds, so we're talking about family offices. They will definitely require more sophisticated depth of market. They will definitely require deeper depth of market, I would say. And if for retail brokers, I don't know, 5 or 7 layers, depth of market will be okay. For funds, usually they require way more than that.
And that was exactly actually my question, is because on the retail side, the liquidity pools, the tight spreads that people are used to, completely changes, when you're speaking to a family office or fund. And then there's a major misconception here. Why am I not able to trade on a zero spread on euro dollar? I mean, the type of flow really defines what type of liquidity. And I'm sure, like you said, we're all going through this, but for me, this is kind of like to share with everybody, why we're talking about liquidity here and the types of liquidity and the different types. We got the defensive feeds, we got full amount feeds, we got retail feeds, we got toxic feeds, and we're trying to kind of customize to accommodate all types of flow. I think that brings me to my next question to you, Wael. I mean, you're more as well on the retail side, and you speak to kind of like underlying retail clients. How do you think, the creating the right liquidity provisions would affect the end client? How do you see the demand? How do you see the education on the end client side? And how much is the focus on the liquidity pools helps you in terms of talking to clients and marketing your products to clients?
Sure.
This is too wild, but you can jump in after. Yeah.
Yeah, it's fine.
Oh,
I'm leaving you to last. Don't worry. You're gonna have the most time.
No, I'm gonna say look, the number of clients and trading volume have been increased significantly after the pandemic time, and that's why we can see that there is a lot of concerns raised from the retail clients today, and they are aware of trading and market conditions more than ever, actually. And we can see from their requirements, so we can maybe in like when it comes to retailers, we have to simplify the terms for like in terms of liquidity and liquidity provision. So like in simple words, maybe you can say that liquidity refers to how easily you can buy or sell assets without affecting the prices. So from that sense, the liquidity affects how quickly, smoothly, and at what price they can trade the clients, the retail clients,
Yeah.
I mean. And also, when it comes to volatility, they have to know that the liquidity or illiquid market, the prices can change more dramatically and lead to higher volatility. And this increases the risk for them because their assets may have bigger value swings, and also it will also be more harder to sell investment or manage their existing position during market uncertainty or market stress. And also, we are turning their attentions also to the how they can diversify their portfolio with the greater liquidity or with the highly liquidity market, because in the like liquid market there are a lot of choices where they can diversify their portfolio and access different investments, where in or while in illiquid market the diversify will be more harder and also maybe limited, that the choices may be limited. So from that sense also, when you talk today to the end clients, uh, focusing on liquidity provision, it can give you an edge because it shows how you maybe how you understand the importance of smooth and cost-effective trading and how they can boost their return through that. And also you can maybe highlight it to also by highlighting this point, maybe it give you more space to emphasize the wide range of investment choices where they can diversify.
Okay. And you think, I think just to kind of, just to follow up on the same question is, in your marketing campaigns, is there a big highlight on, how, I mean, tight spreads, of course, but like,
Yeah.
depth of liquidity, top of book size.
Yeah, this is what
Do
I'm
you
gonna
feel like
say
it's, yeah.
also. Yeah, this is it. Also, that liquidity affects the prices, of course, and in highly liquid market, we can see that a lot of buyers and sellers where they can get better pricing or better spreads, and also this benefit them to reduce the impact of transaction costs on their investment return. So this is very important, yeah, to highlight it today. And also the competition has been raised a lot
Yeah.
today these days, and you can see the like offering raw plus commission or these tend also their attention to this point or significant point.
Anyone else? Yeah, Alex?
I think we're, on the liquidity side of things, and you brought it up regarding prime brokerage and clearing, liquidity execution is one part of liquidity. Liquidity is also, can you get your volume done? Can you hold positions? How big is your counterpart? And I won't get into the regulation against unregulated businesses, but we're all regulated, so let's go that way. But that's another part of liquidity. How good is your broker? Do they have the capital to support prime brokerages, etc.? So we all do that here. And that's a big part of liquidity. It's not just execution and price. It's, can you hold significant positions? We all face similar sort of clients, and people need NOP. Hedge funds, family offices don't trade in $500,000 NOPs. They're $200-300 million NOPs. So that's part of liquidity as well, and that needs to be taken into the consideration where you trade.
Just to add to that, I completely agree with Alex. We've all been in the market for a long time.
That's not the first time either, is it?
No, but no. In terms of the type of liquidity, it is not only spreads. I think everybody knows there's not only pricing and there's spreads. It is really the quality of execution. I think that's similar to what you say. But I could give tight pricing all day long, but if I can't execute on that, that doesn't really do anything for the broker. So there's quite a few people that come to me and say, what's your spreads? What's your pricing like? And I could give you choice all day long, but if I can't execute on it, it's worthless, right? So that's another component of it as well.
And I couldn't agree more with you, Alex. I mean, it's the capital, the regulation is very important. Now it's becoming a lot more important because how much I can take on is of the essence. And after COVID, it feels like the volumes have kind of grown massively from the retail broker side and even from the fund side. And there's a lot of shortage of liquidity because you can't really offer the NOPs that the clients are looking for nowadays. And then it's become a capital play, a regulation play, and how much can you take on? Anya, did you have something to say about this as well?
I always have something.
I like the energy.
Have you about the NOP and like limitations on NOP? I think my question is directed to you. Do you see tendency for liquidity providers to increase their NOP, or like what's your view on that?
Unfortunately, as Mohammed said, I've been around a long time, even before prime brokers even existed. So, look, I'm very much of old school. I think you need as many direct lines and facilitation, direct bilateral counterparts as possible. We've seen in the prime brokerage space, and I see some of our friends out there, but they come and go as much as any other service in the business. So, at Finalto, yes, we have 2 or 3 direct PBs, and we have 4 or 5 direct lines, and that's how we continually facilitate our NOPs. Do we put restrictions on our clients? Yeah, we do on a per product or per symbol, if we want to call that, and we have NOPs. But we also have tiered margining because if we go into the technology side of things, it's our own tech. It is 15, 20 years old, but we keep evolving. So, yeah.
And a lot of this, in my opinion, has changed since the SMB even. I mean, before that, there wasn't that much. And then after COVID, it became worse. And a lot of PPs has withdrawn from that space. And it became harder and harder to get access.
Well, I mean, it's a bit like, when you look, one of the big ones that left after the S&B because they were very concentrated on a certain demographic, right? And some have concentration risk because they're very big in one country, so that makes it an issue, right? So like ourselves, we want diversification, we want global presence. So, somebody in Asia will trade heavily in gold, where another group of clients in the Middle East could be the opposite way in gold because it's a different philosophy, or what's on the news at the time makes them make a different decision. So you do need that demographic, geographic diversification.
Right. Phil, you
No, I was going to say that S&B, as you mentioned, was a big factor in a lot of the space in the market space in general. I was with a firm that had some turbulence, let's say, during that time. And from that point, I think, at least in the region, there's much more focus on kind of the risk management of the business, right? It's not just being large, having liquidity, but also being able to manage your risk, being able to monitor that properly. And I think that's immensely important in any brokerage, regardless of what size.
And this is a point I'm going to come back to, but let me do one question about technology, and then I need to go back to risk management. This is outside of kind of like the question that I shared, because it's been low volatility, 6-7 months in the market now, and risk management questions are being asked quite a lot. But Anya, let me direct this to you before we go into the risk management. Are you ready? Ready. Yeah. So I want to talk a bit about technology. Platforms, GUIs. I know you guys, advanced markets have been involved in kind of technology partnerships before. How do you see, the market in Asia evolving into this? How do you see also from a liquidity perspective? I know we always depended on TY3 for Asia liquidity. Now Singapore is coming up. Do you think Singapore is going to replace TY3 as a liquidity hub? What's your view on?
We need a separate panel to discuss this
question.
question.
I know it's a big thing, but
but we can look at we don't need to guess. We can look at actual data. So the Bank of International Settlements released the results of their triennial survey that they did in 2022. And according to that survey, of course, London is number one. So London takes about, I think, 40% of all, FX market, right? Globally. Then we have New York, I think, at 20%. You can guess number 3 is Singapore, with 9.5% or so. And it's actually up 1% compared to the previous survey. And then we have Hong Kong at 8 or 7%, which is a little down. And then we have Tokyo at 5 or 4%. So if you follow this graph, you can make your own decisions. But at the same time, we also, if we look at the retail brokers, then Japan takes 30% of all retail flow. So if you are targeting, Japanese clients, you have to be in Japan. But if you're in Asia, then you can pick Singapore and Hong Kong. But Hong Kong is, I would say, more cost efficient. And if I were a retail broker, I would definitely go to Hong Kong. I think. Is it?
Phil's looking at me going, have a go. Well, I suppose Phil's in Hong Kong, right? But yeah, for us, as I said before, being MAS regulated, we chose Singapore, just purely on the factor it's closer to surrounding Southeast Asia. Mm-hmm. So it's got Malaysia, other countries north, Cambodia, which has its own regulations and significant regulations, and Indonesia is very similar. Both highly regulated to conduct business there. So we chose Singapore, so it's closer to there. It's close to Hong Kong, and Hong Kong is very much from our side from an FX and precious metal side, very precious metals, but not so much FX. Yeah. Where Singapore's probably more FX, and Phil and I were talking before. Hong Kong's very securities based. So, but I think to Anya's point, if you add up all the Asian volumes, it's bigger than New York. So Asia is growing, and it's for focus.
But
right?
it's the fragmentation that is in the Asia that kind of dials it down a bit.
Correct,
Yeah.
but I mean you've also got the bullion business from India, etc., and Dubai, which as we build up the hub here in Asia, the gold focus could come to this part of the world as well, rather than London.
Do you see like Asian brokers and funds wanting to get liquidity from New York or from New York banks for diversification purpose, because they can get access to like their local liquidity anyway, right? And then they want
I think
different.
it's one of the headwinds, right? So for me, for the retail brokers, depending on if they're using their own technology or say a MetaQuotes has to be hosted, or they use a bridge provider. So we really need those technology providers to embrace coming to Singapore or Hong Kong, and then they can get it. But we provide significant liquidity in Singapore to Asian brokers who have their own tech and have their data centers in the region. So yes, it's a growing business for us, but we talk about Australian brokers, all their servers are NY4, so we don't price anything out of Singapore to them, which is strange, when probably 2/3 of their volume is from Southeast Asia.
Yep.
So it's a matter of that change, technology change more than...
Phil, you had something?
Yeah, no, it's having been in Asia for some time, you've seen an evolution of a lot of the liquidity obviously is still in Japan. A lot of that is Japanese brokerage focused, but you see quite a bit of the institutions kind of migrating slowly, including the LPs, migrating slowly to Singapore. I think I cut out. Sorry.
Cut out.
For the longest time, I think it was a work in progress. Many of the banks were saying, "Look, we're ready. We're migrating. We just need to, just get some of the clients over." So it's a tricky one, really. It's for the last, I would say, almost at least 10 years. It's been like, yeah, it's all moving to Singapore. It hasn't quite yet, in my opinion. It's getting there, I think. But you might have 2 centers at one point. It'll take some time. But yeah, to the point of Singapore and Asia as well, being one of the major hubs and probably the largest in terms of volume. I think some of that includes NDFs, as Alex would agree as well, not necessarily spots, but there's different asset classes as well that are inclusive of that. But yeah.
Okay. Let me get back. Sorry, you want to?
No. I wanted to add something on this regarding the data centers. Basically, I believe that it doesn't have to do necessarily where the broker is based, because most of the brokers, we know that they have in London the servers located. So it depends also on the products. I mean, if the price is created in London, it doesn't matter if the broker is in Asia, if the trader is in Asia. So having a data center in London and perhaps in Asia will be the most efficient way. But due to the cost and everything, we need to be to assess very carefully how our clients trade and what products. For example, if we have some exotic products or some very localized stocks from Chilean stocks or whatever. I mean, you would go to a local LP, but on the major assets that the price creation is in London or in New York, it has to do where the price creation is being.
Yeah, just one quick one. In terms of a lot of the Australian brokers, as you mentioned, have connected into NY4. A lot of that, I think, is old legacy fiber optics, and that was really the quickest way to get liquidity, and that's why that happened. I think slowly migrating to other parts of the world is happening, but that's primarily why that was the.
Okay, I think we have a time for one more question, so I don't want to. It's fluent. So I want to skip regulation. Let's leave it to maybe we have some time for it. But I want to focus on the risk management. It's been a low volatility, maybe 7 to 9 months now in the market, and you can see a lot of the retail brokers and trying to kind of find more creative solutions to liquidity and risk management as well. And a lot of people are delving into the space. A lot of the big companies are delving into the space. We hear some of the crazy offers in the market about the open-ended profit shares and, the things that I don't know, how they do it. But as major market players in the market, how do you guys are approaching this? Are we coming up with solutions? I know we spoke, you and me and Phil, about solutions that you guys are thinking of. What's your take on this, Alex? Maybe it seems there's a major need, major demand on bigger companies, institutional brokers taking that responsibility, at least from an experience perspective, but maybe also from a capital perspective.
I'll just mention that for us, we focus heavily on the risk part of the business. Hence, we have an IS risk product and part of the offering. For those who don't know, you don't necessarily need to take liquidity directly from us. We have an offering for those who simply need a risk management system. We have real-time analytics. We have a management solution or risk management solution that's used really from some of the largest brokers, again, like I mentioned. And we can customize alerts and customize all of these tools for brokers to be able to help mitigate that risk. So we find that it's one of the most important aspects, and it's one that we find that we differentiate ourselves with some other players as well.
Yeah, but my question is more about, what's the concept? Clients are trying to kind of maybe squeeze in another $20, $30 per million and not run traditional B-books. I mean, is that something you believe is doable? Everybody's trying to.
You're looking at me, aren't you?
Come on.
Look, I've been having trade for 25 plus years. I don't particularly like taking second-hand flow and trying to maximising another $200 or $300 a million out of it. And as you said, there's been a lot of deals going on, etc. And actually, Phil and I were talking earlier because we do have competing products, and we do the same as well, right? I think we all do the same. There's been some silly deals out there, but I think we're all experienced enough that we don't want to race to zero because it's unsustainable. So we've missed out on deals recently in the last 12 months, but those deals are coming back. Because I think of the experience of the people we have on our risk management desk know that it's not profitable to do these things. But I think for the type of client that is coming to us for these deals are probably the least capitalised brokers.
Yeah.
I don't know if that's a regulation thing that we should talk about, but the capitalisation and the type of clients that they're probably bringing on is probably wrong for that broker. So there's questions to us.
Super dangerous
there, right?
We have one more minute. If you wanna, Anya, if you wanna jump in, and then we give 3 minutes to the audience if they have any questions.
I'll just say any offer that seems to be too good is most likely not good. And anyone who is willing to accommodate an unreasonable offer should not be taken should be taken seriously. And if you're a retail brokerage, you should run additional due diligence on that. But this request will always be there, and there will be always people who are willing to take them.
True.
And then in a year, we'll see who is in business and who is not.
That's true. All right, thank you. We have 3 minutes, I guess, and if there's any questions from the audience, would like to take it, and you can direct it to any one of our panelists.
We should talk about compliance for 3 minutes.
Yeah. So if there's no questions, we'll go through the regulation. So, okay, I'll do the question quickly. So we have in Europe unified regulation under ESMA and MiFID. Asia is quite fragmented. You got Japan, Australia, Singapore, Hong Kong, and then you got Southeast Asia that's still unregulated. What's your take? How is that gonna affect liquidity? And this question is for everybody.
I don't think it affects liquidity. It affects how you enter each market.
Yeah.
Right. So, Singapore's very clear. Australia, as you said, the main brands are very, very clear. But you have let's call them second-tier countries who have exchanges or have clearing regimes. I think they're going down the right route. I mean, they're trying to protect their investors with trade locally. Don't go offshore. Your money's protected in your local country. That's the same that we're doing in the West or major regulations, but they're starting from scratch, which could be a good thing. They're not having the issues of what we've had previously with over-leverage in countries. So, it's a very fragmented area, but, it's exciting times.
Yeah. Wael, you had something?
I'm gonna add just one point, because unified regulations maybe promote the liquidity and traders also to the market, and maybe can boost the liquidity and the growth in the region as well. So these days also are gonna have something that's the banking, also the banking infrastructure also in the region, also fragmented. So which is also bring more challenges to the industry, because each country has its own banking system, practices, standard. Must individuals and corporates adhere to. So this is also another point. Maybe we can add it to regulation because it's related, banking and regulation.
Anyone else? to
I
jump
think
in on
every
regulation?
expo, when the regulation topic comes up, if you look at all the past videos, by the way, Finance Magnets has a very nice YouTube channel. Subscribe. You can every year everybody says this year was the worst in terms of regulation, and then the next year it's even tougher.
It just keeps getting worse
It
and
just
worse.
getting worse and worse and worse. But industry is shrinking a little bit, and bigger players are becoming bigger.
Right.
And and we're done. So
Yeah. I'm sorry. I think Phil, do you have something to
Oh,
say?
no, I was just saying that regulation in the end of the day is really there to protect the retail investor or to those who are not educated as well.
Yeah.
But the retail investor or the kind of traders that we would have considered less educated are now more educated. They're more sophisticated now. So there's an interesting time now. We think that there's a big opportunity.
Sorry, we run out of time, so I would like to first thank our amazing panelists. That was a very insightful conversation, and thank you all for attending. And thank for IFX Expo for hosting us. Another great show. Thank you very much, guys.
Thanks, Mohammad,
you.
and all the speakers. Thanks very much.